Hello, I'm Ryan Lightfoot-Brown of Funds Calibre. Today, I'm joined by Chris Garsten, the elite-rated manager of the Waverton European Capital Growth Funds. Chris, thank you very much for your time today.
Thank you.
Now, as we sit here in March, we've finally got a Brexit deal, but tensions between Europe and the UK seem to be increasing, if anything, not helped by issues around the vaccine. Does this general narrative worry you at all as a European manager?
Well, the answer to that may surprise the viewers, and as it's slightly counterintuitive, but stock market returns are often remarkably uncorrelated to domestic policies and politics, and the returns are very global. So if one looks at the 10-year returns you've had in the major geographical regions of, say, Europe ex UK, Japan, Asia Pacific, and even emerging markets, over that 10-year period, they've all been roughly the same. And it's only the US that's really stood out with outsized returns. And I think the reason for that is that the regional markets have the same factors. So when Trump is nasty to China, he's also nasty to Europe. And we've all had the same sort of downward path of interest rates. So we try not to get distracted by domestic politics and focus on finding investments bottom up by meeting companies.
And one of the areas you are finding companies is in Northern Europe. Why do you have a preference for that region?
Well, we've had a lot in Scandinavia for a long time, and that's where the stocks are. We go to where we see interesting situations. And basically, if you're a manager of a company, you have to wear three hats. You have to treat your employees well and the environment. You have to grow the firm, and ideally organically, and that's a very Danish business model. You have to treat your shareholders well, and that's where we're looking on our 5 key attributes, particularly the interest aligned angle. And then if you're financial, you have to get on well with the regulator. And it's a tough job being a manager because you've got those 3/4 factors and you have to blend them together. And the factor that drives the share price at the end of the day is earnings per share growth. And we find that Scandinavian companies are very good at putting all that together and driving earnings, and that's why we're heavily in Scandinavia.
I've noticed Germany is another sort of key geographical tilt of the portfolio. You've got names such as Deutsche Post and Deutsche Telekom. What's so attractive about these sort of German utility type companies?
Well, actually, we've got 4 German utility companies, and just to step back for a bit, Germany and France are very different to Scandinavia. They tend to have great products, but they tend to be very sort of volume-driven business models, volume over value. And you're lucky as a shareholder if you get a 30% payout ratio. But when things change, they can change very dramatically. And this is what's been happening in Germany. And so if I take the 4 companies we have, 2 have been fairly recent purchases, one of which is Linde, which is industrial gases. And the trigger for our purchase there was a new chief executive and a new chief financial officer who were both American. And out went the old classic model of volume over value, and in came the American model of value over volume. And so over the last 3 difficult years, sales have declined by $1 billion, but EBIT is up by $1 billion. The second stock we bought is Fraport, which is the airport operator. And we bought that exactly a year ago, with COVID. And a big shock to the system because this had been a very safe, steady utility. And suddenly they had no customers. And so they've made a quarter of their workforce redundant. And what we find intriguing is the shares are still, even now, a third of their 2019 high. But thanks to the cost cutting that I've talked about, we think the profits will be about a third higher than 2019 when passenger volumes return to 2019 levels. And then finally, on the stocks that you mentioned, Deutsche Post, which has been a longer term holding, they own DHL. And just recently that's boomed because there's no competition on the freight side from passenger planes. And the company is very un-German, repatriating all of that booming profits back to shareholders via dividends and share buybacks. And finally, Deutsche Telekom, that's really a story of their US firm. They've got a stake in a US company which generates 2/3 of profits. And that's growing very strongly thanks to a nicer regulatory environment than Europe and consolidation. So they're all very stock-specific stories, but they all meet our investment criteria of interests aligned. And that's why we're overweighting Germany.
Okay. And sort of thinking more broadly now, there's a big push for green infrastructure from the EU as part of the sort of Build Back Better programme. Is this an investment opportunity for you in the funds?
Yeah, Europe's got a whole bundle load of green stocks. Some of them are in the fund, which we think are very interesting, but others, the really high-profile names, we think are now on the expensive side. An example of this could be Vestas, which rose 220% last year. I think a lot of people know that they're the guys that do wind turbines. And in our view, it highlights the need to look at companies through the capital cycle lens. What do I mean by that? Is that you should look at the demand as well as the supply. And so what's happened is that the demand for wind turbines has rocketed. So over the last 5 years, their sales have doubled. But the trouble is that there are 3 players that make wind turbines, and they're all dissatisfied with their market position. They all want more. So the supply has rocketed. So the margins, the operating profit margin has halved. So over this period, the earnings per share has been flat. And so this is why it is not so easy always to find the green winners. Well, what I can say that we've got 60% of the fund in what are called leaders. This is how the MSCI classifies stocks. So either AA or AAA stocks. They're the top ranked stocks. And that compares to about 50% for the market. And indeed, over the last 12 months, MSCI has upgraded 8 of the stocks in our fund and only downgraded 2. So we get a top rating, AAA, for the rate of improvement. And often improvement can come from very small things that doesn't get huge publicity, but is very important for saving the planet. So, for example, one of our AAA rated stocks, which is Metso, a mining equipment player, has reduced the carbon intensity of the electricity it consumes by 60%, thanks to long-term supply contracts in renewable energy. And by rolling out that kind of thinking, we envisage the fund continuing to hold on to its strong MSCI renewables rating.
Now, you and Charles Glasse have been co-managing this fund and working together for around 20 years, longer than most marriages. What is it about that partnership that's worked so well for you? And how do you keep the same job interesting over such a long period of time?
Well, the market is always fascinating. There's always something new. But I think this partnership is unique in continental Europe. I can't think of any other fund management firm that's had that longevity. And I think it really goes back to 2 levels. Before we were bought by Waverton, we had our own company. And Charles was the chief financial officer, and I was the compliance officer. And there's a complete level of trust in terms of our personal integrity. You know, I always trusted him to do the finance job properly, and he trusted me to do compliance. But then at the professional level, I think we're on the same wavelength. So, you know, in the old Warren Buffett maxim, you need to be brave when others are fearful, and fearful when others are brave. You know, this time last year, we were buying some of the cyclicals when there was, you know, media hysteria about the outlook. And just finally, the last note is, I think it's very important. I'd like to think we both kept our humility, because the moment you become arrogant and you stop self-questioning yourself and your colleague, that's when the market beats you. And, you know, if you can admit that you're wrong, then, you know, you can correct any mistakes, hopefully early on.
Well, I think on that note, there's some interesting lessons for us to take away. So thank you very much for your time today.
Well, thank you.
And for more on the elite rated Waverton European Capital Growth Fund, please visit the website fundcaliber.com. And for more from our elite rated managers, please don't forget to like and subscribe below.